soap-related products like diapers, tissue, toilet tissue, napkins are out of stock. Welcome, people. Welcome aboard.
I had a question.
Sure.
When we send you the email, do you send a confirmation email back for when we send in the report, or do you just?
Normal I do, but this time I have too many to respond, so probably I may not be able to.
Oh, okay.
Yeah. Well, if I don't, when I create your report, actually, if I don't find a report from a group, I will ask back whether they turned in or not. Okay. So unless you hear back from me about the missing of your report, think that your report is in my hand. Okay.
Okay.
All right, come aboard, everyone. I just gave a lecture for 10 a.m. class, and looks like Zoom is working pretty well. Okay, so before we get started, just a overall general rule. Okay, by default, I will mute all. Otherwise, we will share the echoes and noises from 40 different places, which will prohibit the lecture. Okay, so I will by default mute everyone, but whenever you need to speak up or have a question, don't hesitate to unmute yourself. I allowed participants to unmute themselves. So whenever you need to speak up, you can unmute yourself. But just know that when you unmute your microphone, the noises in your place can be shared. So make sure that you are in a relatively quiet place when you unmute your microphone. Okay. Welcome aboard. We got 20 people in half of the class. Can you read it? Can you guys see the whiteboard well?
Yeah.
Yes.
Although my handwriting is awful.
Well, I had a question.
Sure.
Is next Thursday canceled?
No, this week Thursday will be canceled, and next week Tuesday will be canceled.
Okay.
So this is I was going to make an announcement once everyone is logged in, but just in advance to let you know, this is a new update from last night. So we are going to have an extended non-instructional days. So this week Thursday, next week Tuesday, there won't be any class. Okay, and the class will resume next week Thursday, which is March 27th, right? Then March 27th.
Oh, has it been decided when the next exam is going to be, or?
So I am going to work on the new course schedule, so we are losing 1 week worth of lecture, right? So I will inevitably have to adjust the course schedule, and I will send out the detail to you guys over the weekend, but most likely I will keep the midterm day as scheduled originally because, I told you in the beginning of the semester, the midterm day and time is fixed, and students must have made the arrangements to be able to attend the exam during that time frame. So I will think I will I will keep the original exam date and time, but the coverage of the content will have to be cut down. And the exam will be given online as well. So I'm going to make announcement once everyone is on board. Let's give it another 5 minutes or so.
Will it be timed?
It will be timed. It will be timed. And most likely it will be the same length of time as our regular lecture. So, and inevitably, I will write the exam as open book and open notes.
Do you think that incident que pasó with
Someone needs to mute himself,
auto worker
and shift
Cage?
voice.
You're full of shit.
All right. 31 people on board. Let's wait another 4 minutes to allow people to log in. What does that funny sound? So once the lecture starts, I will mute everyone. But once again, know that you can unmute yourself whenever you need to speak up or you have a question, okay? So I allowed participants to unmute themselves, so you can unmute yourself, but just when you are unmuting your microphone, your space has to be relatively quiet, okay? Welcome. We have 8 more people to come in, so let's give another 3 minutes. Two more minutes of waiting. No more people. Okay, one more person. Hello, welcome. Okay, are you guys seeing me? Can you guys hear me well? All right. Okay, so before we get started, a couple of general rules and announcements. Okay, so by default, when the lecture starts, I will mute everyone. Okay, otherwise, we are going to share the noises and echoes from 40 different places. So understand that I will have to mute all by default when the lecture is going on, but don't hesitate to unmute yourself whenever you have question or when you have to speak up. I allow the participants to unmute themselves, so you can unmute yourself whenever you have to speak up, but just make sure that when you unmute your microphone, you are in a relatively quiet place. Otherwise, we are going to share the noises and echoes in the place you are in, okay? And second of all, I am going to record this lecture, meaning that when you speak up, you will be recorded as well. So if you don't like to be recorded, you can turn off your camera. That's an option you have, okay? And in terms of the course schedule, as we briefly mentioned earlier per Kevin's question, according to the last night's newly updated decision, we are going to have an extended non-instructional days. So there won't be any class this week Thursday and next week Tuesday. We are going to resume next week Thursday, which is March 26th, okay? So that cuts down our lecture time. So I will have to inevitably adjust the course schedule, which I will work on time later this week, and I will post the updated course schedule on Titanium around the weekend, okay? The exam, second midterm will be given online as well. I am debating between the MLF and Titanium formats. I will explore the both options and choose whatever easier one for you guys, okay? And the third, your project will have to be canceled as well, and I will replace that with an individual handout exercise problem, okay? And what else? Any question regarding how the course will proceed? Are we all good? Okay. Hit this person. Okay. Then I will get started and I will mute everyone once again. And whenever you want to speak up, you can unmute yourself. Okay. And I will start recording as well. Okay. So it's been connected to cloud server. Okay. So hi everyone. It's good to see you guys from here. Of course, it's worse than seeing you guys in person, face to face in classroom, but I'm grateful that we can keep meeting in this virtual space. Okay, so today I'm not going to aim too much because it's a technical virtual test run day. So for today, I'm going to cover the solutions for the second project that you guys just have turned in, and then probably cover about 10 to 12 pages from the new chapter, chapter 15, debt financing. Okay. So let's discuss the solutions for the second group project first. Okay. Let me open up this. Sorry, I have to share screen. Are you guys seeing the Facebook IPO prospectus? Yes. Okay. This is the IPO, Facebook IPO prospectus that you guys must have downloaded from the SEC.gov website. Okay. So this is the typical final prospectus. And the reason why I made or created this exercise is because most IPO exercise, IPO prospectus share the same language, common language. So once you practice reading one, the second time through will be very much way easier. Okay, so this is the front cover page of the Facebook IPO prospectus, from which you could have obtained most of the information needed. First of all, on top of the company logo, one of the most important information of the IPO offering, that is the number of shares being offered. You can check the number from here. So 421 million shares, that is the total number of shares being offered to the public through this IPO, okay? And most IPOs have the combination of primary offering and secondary offering. We have learned from the class there are two kinds of shares that can be offered in the IPO, right? Number one is primary shares. Number two is secondary shares. Primary shares are newly manufactured, newly generated shares that is offered by the company. Therefore, raise new fresh capital to the company. As opposed to that, secondary shares are not new shares. They are old shares that were held by the existing shareholders. And therefore, existing shareholders will offer part of their ownership through the secondary offering. So where can we find the information related to the primary offering and secondary offering? Read the very first sentence of the IPO prospectus. So the funny thing is, or tricky thing is, nowhere in the IPO prospectus, the term primary offering or secondary offering will be used. But you still have to know what part is related to that primary offering and which part is related to the secondary offering. So this is the common phrasing. The company is offering the shares. That is primary part. And the selling shareholders offering, that is secondary part. So we can read that from the prospectus. The primary offering was 180 million shares, and the secondary offering was about 241 million shares. Okay, so this is the information related to the primary versus secondary offering. And scrolling down, we can check another most important IPO information, which is the offer price. So we can see that Facebook IPO was priced at $38 per share. And we learned that in the firm commitment case, the underwriter pays only the wholesale price and the underwriter sells the shares back at the retail price. The retail price is the IPO offer price, okay, which is $38. And the wholesale price the underwriter paid to the company or to the selling in the shareholders, that was $37.58. So the gap between these two prices is the discount or spread or fees captured by the underwriter. Okay, so we can see that underwriter discount or underwriter spread was about 42 cents per share. Okay, and scrolling down, we can also check another important information regarding the greenshoe provision. Nowhere in the Facebook prospectus the term greenshoe provision was used, but know that another name of the greenshoe provision is overall element allocation. And this is normally how the overall element allocation is phrased and included in the prospectus. So you will see a phrase something like, we, the company, and selling stockholders have granted the underwriters the right to purchase up to an additional 63 million shares of common A common stock to cover overall element allocation. So we can see that, yes, greenshoe provision was included in the Facebook deal, and the size was about 63 million shares. Okay, so I will move to the Excel spreadsheet containing the solutions. Okay, so question 1A. You are asked to compute the size of underwriting spread in the Facebook IPO. So we obtained the per share underwriting discount from the prospectus, which was about 42 cents. And we divide that number by the IPO offer price, which is $38, which is equivalent to 1.1%. So the size of underwriting spread that the Facebook gave to its underwriting investment banks was 1.1%. How does that compare to a typical size of underwriting spread? What is the typical size of underwriting spread in the US deals? Anyone who can speak up or want to speak up? Feel free to unmute yourself if you know the answer. Well, the typical underwriting spread in case of firm commitment deal in the US is 7%. Compared to that typical 7%, 1.1% spread that the Facebook paid out to its investment banking firms was very small. But even at this slim margin, due to the sheer size of the deal, Facebook raised more than $20 billion through this IPO. So even at this slim margin, underwriting investment banks could make a lot of money, right? But the textbook says, regardless of the size of the deal, the size of the underwriting spread is almost always 7%. But we are seeing more often, especially in the mega deals recently, we are seeing that that 7% rule is broken. Okay, so if the trend continues like this, then the textbook may have to be updated. So I told you in many aspects, Facebook IPO was unusual or not like an average cases that we have learned from the textbook. Okay, so that's why I have chosen Facebook IPO case. Moving down to question 1B, which was asking the relative size of primary offering and secondary offering. We have obtained that information from the prospectus, right? So primary offering was 180 million shares. Secondary offering was about 241 million shares. Combining the two, the total size of IPO offering was 421 million shares, right? In terms of the relative portion, primary portion accounted for about 43%. Secondary accounted for about 57%. Okay. Well, by reading by looking at the relative size of the primary and secondary offering, actually we can, to some degree, read the mind of the Facebook management. Recall that two main motivations or reasons why a company would go public is number one, raising fresh capital. Number two is to give diversification opportunities to the existing investors, including founders, angels, and venture capitalists, right? But know that only the primary offering will raise fresh new capital to the company, right? And the fact that in the case of Facebook IPO, the primary offering was smaller than secondary offering tells about their primary motivation of IPO, right? What do you think? What do you think? What was the primary motivation of the IPO in the case of Facebook? Any thought? Feel free to speak up if you have any opinion or thought. Well, by the way, chatting option is not very much desirable while the lecture is going on because I cannot, it's hard for me to give a lecture and also read the chatting and also typing, okay? So please speak up if you need to. Okay, only the primary offering is raising fresh capital to the company. And we see that in the case of Facebook IPO, primary offering was smaller than the secondary offering. So we can see that in the case of Facebook IPO, the diversification need was stronger than capital raising need. Okay? Most companies that go public, the primary number one reason for IPO is raising capital. But in case of Facebook, the diversification motivation was quite stronger, as we can see the relative size of secondary offering, primary offering. Okay? And Facebook was very, very successful even before they went to public. And not surprisingly, many of the early investors, they had a strong incentives to cash in some of their early investment. Okay, and that's why we can see that one of the primary motivation behind the Facebook IPO was giving the diversification opportunity to the early investors. Moving down to 1C regarding the greenshoe provision. Yes, the greenshoe provision was included in the Facebook IPO, and the size was 63 million shares. In terms of the percentage, we always divide the number of shares given in overall element by the original total size. Okay, so in terms of percentage, that is 15%. Okay, I don't know why, but in most cases, 99.99%, if greenshoe provision is included, the size is always 15% of the original offer size. So probably in the midterm 2, you are asked to compute the size of the overall element allocation, and you happen to see the number different than 15%, you can tell your answer is wrong. Okay. All right, question 2. Here you are asked to compute the underpricing magnitude. Okay, underpricing magnitude is basically computed as a first trading day return. How do we compute that? We first have to obtain the first trading day closing price, which was $38.23, and we basically compute the first trading day return. IPO offer price was $38 per share. So to compute the first trading day return from the first trading day closing price, we subtract the IPO offer price and divide the whole thing by the IPO offer price. In that way, we can compute the underpricing magnitude, basically the first trading day return. So we can see that in case of the Facebook, the underpricing magnitude was only 0.61%. How does that compare to a typical size of underpricing magnitude in the US? What is the average underpricing magnitude in the US IPO deals? Do you guys know?
Is it 8%?
17% actually. So if you guys go back to the IPO puzzle number 1 related to the underpricing, the average underpricing in the US IPO deals is about 17 to 18%. Compared to that, 0.61% was way, way too small. Okay, is that a good thing or a bad thing? The fact that Facebook had almost zero underpricing, is that a good thing or a bad thing?
A good thing.
Good thing. Why?
Because it's not its prices weren't as underpriced. Like it's a very low percentage compared to 17%.
Right. So from the capital raising perspective, close to zero underpricing means that Facebook could price its shares almost exactly. Therefore, they lost almost nothing in terms of the capital raising, right? They raised the maximum amount of capital they could have raised, right? So from the capital raising perspective, definitely it was a good thing. But very small underpricing is not always the happiest thing to see, because the fact that average underpricing is 17%, it means that investors are sort of expecting to earn about 17% over a day, right? And the Facebook was one of the most high-profile IPOs in history, and investors were so excited and enthusiastic to earn a lot of money over a day. But opening the door and opening the cap, the result was so sort of disappointing to investor perspective, right? They could have earned only 0.61% return as opposed to average 17% return. So investors were very unhappy and disappointed to the point that they were angry and they almost filed a lawsuit against the company. Claiming there was some sort of insider trading, or some sort of breach of information, etc., etc. So the Mark Zuckerberg and the Facebook had to go through a lot of turmoils and sufferings in the beginning of their public lives. Okay, so very small underpricing, it has pros and cons. Definitely from the capital raising perspective, it's a good thing. But if it's too low to the point that you make investors so disappointed, you will have to be ready to deal with a lot of complaints, okay, right? So that was what Facebook had to deal with in the beginning. Moving down to question 3. Here, our main goal was to compute the Facebook's short-term performance in question A and long-term performance in question B, and compare the pattern of the Facebook performance, the typical pattern of IPO stocks. First of all, in question A, you were asked to compute the 3-month short-term performance of the Facebook stock. So the assumption here we made was that we pretend we bought each share of Facebook for the first trading day closing price, which was $38.23, and hold it for 3 months and sell them back 3 months later. So first of all, we have obtained the stock price 3 months later, which was $19.05. Wow, the price has been halved almost, right? So computing first the gross return, which is a 3-month holding period return, you can see that the 3-month return was almost negative 50%. Okay, so you lost almost half of your money over the 3-month period. Whenever we discuss the performance and return, we compute the annualized return because having the same investment horizon is necessary to compare the returns, right? Earning 1% overnight is totally different from earning 1% over a year, right? So we convert the holding period return to the annualized return. You could have done so using the equation given in the study guideline. So this computes the kind of return that you will have if you keep losing half of your money every quarter 4 times consecutively, right? Then in that case, your equivalent annual return is almost negative 94%. You have lost almost all your money, okay? So this is the annualized return if you have invested in Facebook short term. Now let's take a look at the Facebook's long-term performance. So in this scenario, we still pretend that we bought the share for the first trading day closing price, but rather we will keep it for 3 years instead of 3 months, okay? And now let's check the closing price of Facebook stock 3 years later. It was $80.88, okay? So computing the gross return, holding period return, the return that you have generated was 111%, okay? In terms of the annualized return, that's equivalent to earning 28% every year, 3 times consecutively, okay? That is pretty much stunning compared to the average IPO stock performance. For your reference, average annualized return performance of the US IPO stock is about 7%. So Facebook's performance was about 4 times better than average, okay? So how do we compare the Facebook's performance pattern to a typical pattern? What did we observe by this computation? Any thought?
Isn't the average holding period for an IPO roughly around 22%?
Yeah, 22% over 36 months. So compared to that, Facebook generated 111%, right?
So it over exceeded by 80
Yeah. So
something
long-term
percent.
performance of Facebook was way better than the average long-term performance of IPO stocks. How about their Facebook's short-term performance? I didn't give you any particular number in terms of the IPO stock short-term performance, but they do very well in short term, right? Compared to that, how did Facebook do? They did very badly, right? If you invest in the Facebook short term, you lost almost all of your money, right? The typical pattern of the IPO stock performance is doing very well in the short term and do bad in the long term. But in case of the Facebook, They did very bad in the short term, but they did very well in the long term. So the kind of opposite pattern was observed. Okay. So this is a second aspect of Facebook IPO, which was different from the average cases that we have discussed in the textbook. Okay. Let's move down to question 4. And now let's see what kind of money the early investors to Facebook made. Okay. So one of the early investors to the Facebook was a Microsoft company. Okay. So Microsoft actually was one of the strategic buyers, which injected $240 million as early as October 2007, before Facebook went to public. Okay. And we could have obtained the number of shares that Microsoft received in return, which was 32.7 million shares. So this information was obtained from the prospectus, the ownership table, right? By observing these two data points, we can infer the implied per share stock price that the Microsoft paid, right? So we divide the dollar amount given by the number of shares received, right? So when we do that, the per share stock price, the implied per share stock price that the Microsoft paid to Facebook was about $7.32. So Microsoft could acquire each share of Facebook for $7.32. Okay. And now let's assume that Microsoft sold off all of its holdings at the IPO offer price, which was $38 per share. And from the time the Microsoft gave money to Facebook, which was October 2007, until the IPO time, which was May 2012, 55 months have passed. Okay, so for the Microsoft case, the holding period was 55 months. The gross return over that period was 419%. It's equivalent that you acquired each share of Facebook for $7.32 and sold them off for $38 each. Okay, so the return was 419% total, which was equivalent to annualized return of 43.24%. Okay. In terms of the gross dollar amount raised, if all shares were sold at the IPO offer price, that was $1.2 billion. Just simply multiplying the number of shares held by Microsoft by the IPO offer price, $38. So Microsoft's $240 million investment turned out to be $1.2 billion in less than 5-year period. Are you impressed? That's pretty good amount of money, right? If you are surprised, write it to be surprised even more. Okay, so moving down to question 5. Okay, let's see what kind of money one of the early angel investors made, Peter Thiel. Okay, so as we learned from the classroom, the Peter Thiel was one of the first angel investors who provided the capital, very first external equity capital to the Facebook as early as September 2004. And Peter Thiel, in his angel investing, gave $500,000 to the Facebook. In return, he received 32.8 million shares. Well, his holding is a little complicated because he made multiple investment into Facebook, both in terms of angel investing and venture capital investing. So his personal owning is a combination of his both investment, but here we want to tease out his angel investing portion only. So from the footnote 16, we could have known the shares received by Peter Thiel for his angel investing portion, which was held by Rivendell One LLC. And the number was 32.8 million shares. So now we can compute the implied per share stock price that Mr. Peter Thiel paid to Facebook. Divide the amount of capital given by the number of shares received. So, don't be surprised. You are reading it right. So the per share price that the Mr. Peter Thiel paid to Facebook was literally a penny and a half. So Mr. Peter Thiel could have acquired each share of Facebook for 1 penny and a half. Okay. And once again, let's make a conservative scenario that Mr. Peter Thiel sold off all of his holdings at the IPO offer price in May 2012. So in this case, his holding period is from September 2004 until May 2012, which is 92 months. So his purchase price is penny and a half, and he's selling his shares for $38 per share, right? Then his 92-month holding period return is stunning. It's 249,755%. That's even hard to pronounce, right? And annualized return is equivalent to 177%. This is almost like doubling your money for close to 8 years consecutively every year, right? That is stunning. So in terms of the dollar, his $500,000 early investment turned out to be $1.2 billion in less than 8 years, okay? So this is how you make money. Any questions so far about the Cure project? Any question? Okay, the solutions, this Excel spreadsheet solution will be posted on Titanium later today. So if you want, take a look at and compare, you can compare that to your own solutions, okay?
I have a question.
Sure, absolutely.
What's the margin of error of, let's say, like one of our answers is like slightly off of the answer? Like if we get like 180% versus 177% for like one of the answers.
So could you repeat your question? I couldn't understand you.
Like to get full credit, what's like the margin of error?
A margin of error. You know, I don't complain that much, you know.
Okay.
Yeah, so yeah. You don't need to worry about the, you know.
Thank you.
Yeah. Okay, so I'll close the Excel spreadsheet. And close the document as well. And I will share the PowerPoint slide. Are you guys all seeing the PowerPoint slide? Yes?
Yeah.
Okay. Okay, so from now on, unless you have further questions, I will move on to the new chapter, okay? So in chapter 14, what did we learn? We learned about how to raise equity capital, right? And we learned about many different kinds of equity capital, and we learned about regulatory requirements and steps and procedures to raise equity capital, right? And then we discussed a lot about the equity raising. In this chapter, we are going to turn our eyes to another alternative source of capital, which is debt, okay? So chapter 15 is about debt capital or debt financing. Let me show you this diagram once again that summarizes the flow of capital surrounding a company. So first of all, you know, the company will raise capital from the external capital market and put that money wisely into various investments and harvest the profits and keep portion of the profits within the company for future projects and growth. And the portion of the profits is paid out to the capital providers to compensate their capital provision, right? We are, in terms of this diagram, we are still in this first area, raising capital from the external capital market. In chapter 14, we discussed one form of capital raising, which was equity. And in this chapter, we are going to discuss the second option of the capital the firm has, which is debt, okay? So first of all, let's discuss the corporate debt. Introduction first, sorry. Well, just like all other contracts, debt contracting also involves two parties. On the one hand, you have a company which is raising debt capital, and in the debt capital contract context, we call that borrower. Okay. The other end of the contract is lenders, who is giving money to the company. Okay. So this is how the money flows between the two parties. Okay. Today, the lenders will give the cash to the company, and the company will use that cash to undertake valuable investments. And in return, the company promises to pay back certain amount of cash to the lenders in the form of interest and also in the form of the principal payment. And in the debt contract, the amount of the future payment and timing as well will be specified. Okay. Well, at a first glance, there are so many different forms of debt, starting from the bank loans to the public bonds. So you may be confused to call which one should be called debt. But all of the contracts share some common features to be called a debt contract. Okay. First of all, the most important feature of the debt contract is the presence of promises. So in a debt contract, the borrower, the company, will promise a certain stream of interest and principal payments to the lenders or debt holders. Okay, so this is the most important characteristic of the debt contract that makes it distinguish it from the equity raising. Okay, recall that in the equity contracting there was no such promise or guarantees, right? But in the debt contracting, there is a promise given by the company to the investors in the form, the size of the payment and also the timing of the payment. Okay. Second characteristic of a debt contracting is that the lenders are not an owner of the corporations. What do you mean by that? It means that debt holders and lenders, they do not have any voting rights as opposed to equity holders and shareholders. Equity holders or shareholders, they do have voting rights, so they can make voices over important corporate decisions, right? But lenders don't get that right. So as long as they receive the promised money, they should be happy and set back. They cannot make voices and opinions in terms of how the business should be run. Okay. But characteristic 3, that changes quickly as soon as the promises are breached. So once again, the most important characteristic of the debt contracting is the promises in terms of the amount of cash to be paid back to the lenders. Okay, whenever those promises are broken, we call that situation a default. Okay, and when default happens, the debt holders and lenders can take the company to the bankruptcy court or make the company liquidated, and effectively they will override the equity holders. So in case of default, unlike in the normal course of the business, in case of the default, debt holders and lenders, they have a priority over equity holders, and they can actually become effective new owners of the company. Okay, so if the default happens, equity holders no right. Okay, and debt holders will dictate how the company will have to be coming out of this difficult situation. Okay. Continuing our discussion, let's compare equity and debt. Okay. So first of all, one of the characteristics of the debt capital or debt contract is that lender is not the owner of the firm and they don't have the voting right. As opposed to that, equity holders and shareholders, they are the owners of the firm, meaning that they do have voting power. Well, do you feel that you have voting power when you are holding some shares of the company? Actually, you do, but you may not feel it that much when you're holding a tiny bit of shares, because when you're holding a small number of shares, your voting power is most likely delegated to the large institutions. But even when you're holding just one share, you do have a voting power, right? So shareholders are in some sense true owners of the firm, and they do have voting power over how the firm has to be run, okay? Second characteristics, debt contracting. Most of the debt contracting has an expiration date or maturity date, meaning that we know at the inception of the contract, we know when the contract will end, okay? The length of the contract can be short-term or long-term, but in most debt contracting case, we know when exactly that contracting will be ending. That is not true in the equity contracting. In the equity contracting, we do not have such an expiration date. Recall what happens when you buy a share. Is there a certain date that you have to sell the share? There's no such a date, meaning that equity contracting is by nature open-ended, okay? And there's no expiration date. As we have felt from the equity and firm valuation, this open-ended nature of equity contracting is making the valuation of equity much harder than the valuation of debt. Okay, but in case of debt contracting, we know the length of it, and the cash flow stream is actually defined in the contracting. Therefore, the valuation becomes much easier in case of the debt compared to the equity. Third characteristics, lender's claim on the corporation is specified, in other words, promised in the form of interest and principal. In the original debt contracting document, the lenders will know what amount of money will be paid back to them on what certain dates. Okay, so they know exactly what amount of cash they will receive in what time. Equity holders don't have that promises, okay? So shareholders have only general right to receive dividends, but dividend is not the obligation. There's no promised dates or amounts in terms of the dividend payment, okay? So we call the shareholders residual claimants, okay? So if something left after paying the debt holders fully, then company can decide to declare some dividend, but firm is not obligated to do. So moving on. So that being said, payment to debt holders is an obligation. Therefore, it is a liability. So if the company fails to meet those promises, the debt holders can take legal action. They have legal power over unpaid interest and unpaid principal. The debt holders can take the company into the bankruptcy court and decide how the firm should be reorganized. Equity holders do not have such legal power. The dividend payment is not an obligation on the firm's part, okay? So even if shareholders are disappointed by less than expected dividend amount or less than expected share price, they can complain and they may be able to sell shares, but they cannot take any legal action. They don't have any legal power in terms of unpaid dividend or less than expected dividend, okay? Last important difference between debt and equity is the tax treatment. We are going to discuss this feature more in detail in Chapter 16, Capital Structure, when we combine debt and equity. But for now, know that the amount of cash the company uses to compensate debt holders, lenders, is tax deductible. But the amount of cash the company uses to pay back equity holders in terms of dividend is not tax deductible. So recall how you do your personal tax filing. There are certain expenses that are tax deductible and certain expenses are not tax deductible. Same thing happens to the corporations as well. Certain expenses are tax deductible and therefore reduce your tax bill, and some expenses are not. In terms of capital raising, if you raise debt capital and use cash to pay back the debt holders, that portion is tax deductible, and therefore it will cut down your tax bill. But if you raise equity capital and you use cash to pay dividend to equity holders, that is paid out from the after-tax dollars, and you're not gonna save even a single dollar from your tax bill. Okay, so we are going to discuss the effect of this differential tax treatment when we do the Chapter 16 capital structure. Okay. Any questions so far? Are we good? All right, now let's discuss the details of the corporate debt. Broadly speaking, there are private debt and public debt. Just recall that in equity, we could have raised equity both privately and publicly, right? Same thing happens to the debt raising. You can raise debt both privately and publicly, okay? First of all, what is private debt? Let's discuss private debt first, okay? Private debt is debt negotiated directly with a bank or just a small number of investors, okay, through a private negotiation. Okay? So that being said, the claims private debt is not publicly traded. There is no marketplace for that. Okay, just recall that in the equity raising as well, private equity there was no easy trading market as opposed to public equity, right? Same thing happens here. When the debt is privately raised, trading becomes a big issue. There's no easy marketplace to trade your claims in a company, okay? Well, the examples of private debt include bank loans, and bank loans are the most typical and most prevailing form of private debt, but it's not the entire story. There are some other forms of private debt, which is called private placements, which we'll discuss most likely next week. Okay. Well, one thing that you have to keep in mind is the importance of private debt. Oftentimes, students think public debt market will be larger than the private debt market, but actually the truth is, sorry, where did I go? The truth is, private debt market is larger than the public debt market. Oftentimes, students think public debt market is larger because it's more visible, right? And private debt market is less visible because we are not getting involved in those deals. But the truth is, private debt market is larger than the public debt market. And actually, private debt is one of the most important financing sources for many companies. So normally, the first form of debt financing happens through the private deal. So for many young firms, private debt market is a very important source of financing. And even very large established firms, they keep on using bank loans as part of their debt financing. So know that the private debt market is a very important financing market for many US corporations, okay? Before we discuss each kind of private debt, let's discuss the advantages and disadvantages of raising debt privately compared to raising it publicly. So why do you think the advantages of raising debt privately as opposed to raising it publicly? Recall from chapter 14, we discussed the pros and cons of going public, raising equity publicly as opposed to raising it privately, right? So similar discussions can be applied here. Any thoughts?
Less regulations, maybe?
Yes, regulations. So know that whenever the company wants to raise capital publicly, SEC will become very sensitive and paranoid, okay? Because when you open the door wide open to everyone, mamas and papas can be involved as well. And the SEC wants to protect them appropriately, right? So whenever the company wants to raise capital publicly from the random general public investors, there will be way more amount of regulations and stricter regulations, okay? So the advantage of raising debt privately is you can avoid all those regulatory burdens, right? Good point. What else? What is the benefit of doing private custom-made deals as opposed to public ready-made deals?
You can keep track of them.
You can keep track of them. What's the advantage of keep tracking of them?
So that you're not losing out on like deals or money.
That was a little vague statement.
Mm-hmm.
So when you have small number of people involved, negotiation becomes easier, right? But when you have to deal with like million random people, negotiation becomes almost impossible, right? So when you raise debt privately, you can enjoy more flexibility, right? So you can actually customize the terms and conditions of the contract as long as the involved parties reach to an agreement. But when it comes to public offering, you cannot enjoy that luxury because you're dealing with a million random people and you cannot negotiate with them, right? So you just put the take or not deal on the table, and investors take it or not, right? So there's no negotiation. What else?
It's cheaper. If you
Cheaper?
were to issue debt, you'd have to comply with the SEC for all
Right,
those
right,
administrative costs.
right, exactly. Recall what happened when the company wanted to do the IPO. They had to file with the SEC and they have to prepare all those filing documents, etc., and wait for the quiet period, etc., which adds up to the admin cost, right? When you do the private deal, you can avoid all those regulatory costs, right? So private deals are normally cheaper and also faster because you don't need to wait for the regulatory requirements, right? Or approval. What else? Okay, I think we have covered pretty much all. So private debt, raising debt privately, that's cheaper and faster because you can avoid the cost and delay registration requirement related to the SEC. And you are subject to lighter regulations. So always know that when the public offering is involved, SEC will require a more set of requirements and also stricter set of regulations. Okay, in case of private deal, you don't need to conform to the same high standards as public debt. Third, flexibility, we discussed that. So everything can be tailored and customized to the particular need of and situation of a company, as long as the involved parties can reach an agreement. In case of public debt offering, you cannot afford that kind of luxury because basically the negotiation becomes impossible. You are dealing with a million number of people and you cannot negotiate it, right? You just take or leave deal on the table and investors just decide to buy or not. Okay. The fourth advantage of the private debt is the monitoring. Okay. So we discussed this point in the equity capital as well. So when the company offers stock publicly and therefore it is diffusely held by million number of people, monitoring becomes an issue. So when a small number of investors are holding significant portion in a company, investors do have incentives to monitor that the firm is run in the best interest of the shareholders. But when it is diffusely held by million number of people and each investor has small stake in a company, no one has strong enough incentives to closely monitor what's going on inside the company. If they are unhappy and disagree with the management, they can just sell and walk away. Same thing happens in the private versus public debt as well. When the debt is privately raised, normally you borrow big amount of money from a bank, and the bank is just like a local bank across the street, and they can observe you, and they have a big stake in your company, so they will make sure that you are using the money in the best interest of the investors. As opposed to that, when the public debt is issued to million number of people, they have only small stake in a company, so they pretty much don't care much. If they disagree or they are disappointed by the performance, they can just sell off the bond and leave the company. The monitoring becomes an issue in case of public debt raising. What would be the disadvantage of raising private debt as opposed to public debt? From the investor perspective, so imagine you are a bank which lended a big amount of money to a company. And what would be the main disadvantage of this deal as opposed to buying public bond issued by this company? Any thought? So by the definition of the private debt, there's no public marketplace to trade your claim. So illiquidity becomes your concern. So suppose you're a bank which lended a big amount of money to a company. And suppose later on you want to change your mind. You think that the company is too risky and you want to sort of diversify your portfolio by shedding some portion of your claim away the company. But there's no easy way out, right? Because there's no public marketplace to trade your claim. Okay, so in case of the private debt, due to the lack of public marketplace, illiquidity becomes a concern. So from the investor perspective, getting involved in a private debt as opposed to buying public debt requires some degree of illiquidity. Okay, so that's the main disadvantages of getting involved in a private debt. Any question? How are we doing on time? Okay, so for today it was technical test run, so I'm not going to aim too much. So I will end the lecture from here. Okay.
Question.
Sure.
Oh, I got disconnected earlier. Did you say when estimated time, like, we'll know the changes to the class?
So yes, I am going to work on the new class schedule probably tomorrow or on Thursday. So I will upload the new course schedule most likely either on Thursday or by Friday. And I will make an email announcement about that.
Oh, I had another question just about my report. I don't know if I should ask it here or. Oh, I noticed a typo on my report. Like 2 numbers got switched. Does that really matter? Because it was.
No.
I wrote the equation and it was for the profit, not the revenue.
It's okay.
So
it's okay. I don't complain. Revenue versus profits. It's okay.
Oh, I resubmitted it, but does that matter or not?
I will see the time. If you have submitted it after I discuss the solutions, I won't be able to accept it.
Oh, okay. But I submitted an earlier version.
Okay. All right.
Oh, you just grade the earlier version, and that's.
Okay.
Okay.
All right. So guys, was there any technical issue faced by any of you? So are we all doing okay?
Yeah, it was fine.
Okay, sounds great. Okay, so I will, in terms of the recorded video, I have practiced that earlier for my 10 a.m. class, but the file is way too big to be posted on the Titanium. So I instead recorded on the cloud. So I will shortly, when it's ready, I will send out a link to the cloud location. From there, you can download the recorded lecture video for today, but know that you have only 24 hours to download it, okay? So once the video is ready and the link is available, I will send out an email, but make sure to download it within 24 hours if you want to download the recorded video, okay? And once again, second announcement, this week, Thursday, and next week, Tuesday, we don't have classes, okay? So we will resume our Zoom lecture next week, Thursday, which is March 26th. And once again, sometime later this week, either Thursday or Friday, I will upload the updated course schedule. And I will maintain, most likely, I will maintain the midterm 2 date and time, but it will be given through the online, either through the MLF or Titanium. And third group project will be canceled and it will be replaced with a individual handout problem workout, okay? Any question?
Oh, if I made like a typo on the number, like 2 numbers got switched, but the equation is right, do we get like minus points or?
If the equation is right, I deduct just marginal point, probably 1 point. So don't worry too much.
Okay, but like my revenue is correct, but the profit, which we didn't need, is incorrect. So I don't know if I would lost points or.
Okay. All right. So when it comes to office hours, I will keep meeting you guys through Zoom from 1 p.m. to 2:30 p.m. But when it comes to office hours, please know that it cannot be an individual one-on-one meeting, okay? So we are going to share the virtual space with everyone, right? So please understand this limit when I have to host the office hours through the Zoom, okay? So if you have any question or need further help, you can see me at Zoom from 1 p.m. to 2:30 p.m. But just know that you can be sharing my office hours with other people as well. Okay? Any question? The midterm due date won't be changing. Okay, most likely. I will send out the most new updates later this week. Okay.
Oh, wait, so just the same question. Will I get marked off if my profit is wrong, but my revenue is correct?
No markdown. Okay.
Okay.
And question
Alright.
like this can be asked through the office hours. Okay. All right. Are we all doing good? All
Yeah.
right, and I will dismiss you guys, and I will see you guys again next week, Thursday. Okay? Stay healthy and stay bright, even though there are so many gloomy things out there. Okay? Bye. Have a good day.